Is my screen visible now?
Yes, sir.
Yes, sir.
So, hello everyone, welcome to week 3 live session for corporate finance course. And a brief overview of the content which was covered in the third week of the course is like the annuities and perpetuities which were discussed in week 2. Some applications of those, like how annuities are annuities calculation can be applied for the loan repayment calculations, and how the concept of perpetuity is applicable to stock valuation or the valuation of companies, etc. So these type of applications were discussed, and we will take some examples of that. And later, the various capital budgeting rules were explored, and mainly four capital budgeting rules were there in the discussion. One and most powerful is the net present value, and others are internal rate of return, profitability index, and payback rule. And at the end of the lectures, like there was a discussion of like if like the in the earlier discussion, the assumption is that interest rate is fixed over time and it is not changing. So the time variation in the interest rate is offered, and then the concept of annualized rates was discussed. So we will take some examples and try to have a recap of all these concepts. And please feel free to stop me anywhere if you have any doubts or any clarifications needed. Okay. So let's first take an example of loan repayment and how we can apply the concept of annuity calculation in this, like how can we calculate the EMI value using the annuity formula. So for example, you go to a bank and suppose you want to purchase a new gadget, or you want to purchase a new bike, anything, and you want to take a loan. Okay, so you go to the bank and take a loan of 2 lakh rupees, and bank states that there will be a 12% annual interest rate. And why we say quoted? So because in the banking norms, when we say 12% annual, so it can be by simple division. We can like reduce it to the monthly interest rates or quarterly interest rate by dividing the number of time frames which will be there in there. So for example, if I want to compute the monthly interest rate, then I will simply divide it by 12. Okay, this is taken for the simplification purpose. And so for example, in this loan process, you opt for a EMI of 10 years, and then the question is like what will be your equated monthly payment or EMI for this loan. So how can we do that? So this is an example of annuity, like annuity which gives you, like in which you have to pay a same amount for 10 years each month. So 120 times you have to pay the same amount, and that annuity's present value should be equal to this loan amount, correct? So we will do that calculation. So the present value should be equal to the current amount of the loan, that is 2 lakh rupees, and the present value of annuity which pays the C is the my EMI, the constant payment which you will be paying per month against this loan. And if you put all the values here, then you can compute the EMI value for this loan. So for example, here are the interest rate, because these are monthly payments. So the monthly interest rate will be used. So monthly interest rate would be 1%, and total time periods will be 120 periods will be there. So T is equal to 120. So if we put all the values, then we can compute the EMI value, and that comes out to be like 2,869 rupees. Okay, So this type of concept can be used to compare like whether, if like nowadays on a lot of products are offered on EMI value, so you can compare using this formula, compare using this calculation, like whether this offer of EMI is worth taking or not. Okay. Now next part of the question asks like, if you wish to settle the loan at the end of 5 years. For example, like you took the loan for 10 years, but like you have a change of profession or you change the job and you get a hike in the 5 years and you have enough savings so that you can pay your loan at the end of 5 years. So the question is like how much would you need to pay at this time? And the assumption is like there is no fees or no charges are there for the prepayment of the loan. But in reality, there are some charges if you prepay the loan. But here we are taking the assumption that there is no prepayment charges. Okay. So what do we do like when we want to get the lump sum amount which you have to pay after a certain amount of time? So for that, like we have to do, like we have to do the calculation for each month. Like each month, what will happen? So for like in first month, when you pay the EMI, you pay the interest on your loan, and plus you pay amount more. Your EMI amount is more than the interest. So the amount is the amount which you are deducting from your actual principal or the loan amount. So for example, in first month, so the loan amount is 2 lakh rupees and interest rate, like monthly interest rate is 1%. So 1% is 2000 rupees is the interest for 1 month, and your EMI payment, which we calculated using EMI formula, that is 2869. So we can compute like what is my remaining principal. So 2 lakh plus 2000 minus the EMI amount. So the remaining principal will be 1,99,130 rupees. So this loan amount is carried forward in the next month, and we do the same calculation for the second month, for third month, and up to like, so the question asks for the end of 5 years. So in the 60, after the 60th month, what is the remaining principal? That is the loan amount that is there in your account. So if you want to settle at that time, that is the amount you need to pay. So like doing this calculation manually is very cumbersome. So yet we can make use of Microsoft Excel or other spreadsheet programs. So I will show you the calculation using the Microsoft Excel. So for example, so this is our like the situation, like the loan amount is 2 lakh rupees, monthly interest rate is 1%, and total duration of the loan is 120 months. So what we do, like we calculate the EMI amount using the annuity formula. We do these calculations using like for the first month, like we compute the interest by multiplying interest rate to the loan amount, and then we compute the remaining principal, and we do this calculation for like in Excel. We can simply drag the formula for the each cell. So for example, if you don't have these values for remaining months, so what you can do simply, like you can simply drag this formula, like doing control. If you press control D, then this formula will be computed for each of the month. So if you do this calculation for all the months, so you will see like in the month 120th month, so when the 10 years complete, so you see the remaining principal amount that becomes like approximately zero. We see a value different than zero because of the rounding of errors which are there. So that is the issue. Otherwise, like you can see like the my loan amount goes down to zero in the 20th month. So now if I want to see like what is my remaining principal in my loan account, that is like at the end of 60th month, like after 5 years, that is equal to 1,28,995 rupees lump sum. So this is the amount that you will need to pay if you want to settle after 5 years. Okay. Any questions on this, like how we do this calculation? I will share this Excel sheet and these slides with you, and you can, like in the Excel sheet you can do changes in your calculation, like you can change the loan amount, you can change the interest rate, you can change the duration of the loan also. But for that, like you have to include more number of cells in your calculations, and you have to drag the formulas accordingly. That is the only change you need to make. So we calculated this remaining principal, like what is my remaining principal after 60 months, that is 1,28,995 rupees. So this is the amount you need to pay for early closure of loan, like given that there is no prepayment costs associated with your loan. Okay, great. Now we move to the another application of our concept of perpetuity. So in the lectures we studied about the Gordon growth formula, which is applied to the valuation of stocks. So how that is applied? So we take an example. So for example, a stock is there which pays a annual dividend of 20 rupees, and this dividend is expected to increase by 2% year per year forever. A stock, like as we discussed in our last lecture also, like a share or is, there is no maturity for a stock. It is assumed to like the exist forever when it is there. Okay, and according to that conception we do the valuation of these stocks. Okay, and now it says like the current price of this stock is 400 rupees, and if we say like this is fairly priced, then at what cost of capital is this stock is priced? So here, like we apply the perpetuity formula, and through perpetuity formula, the professor derived the Gordon growth formula for stock valuation, which says like the Gordon growth formula says like what is the current dividend that is being paid divided by the cost of capital or the prevailing discount rate, in other words, minus the growth rate of dividend, that should be equal to the current share price. So this formula is same as the growing perpetuity, present value of growing perpetuity. So this stock is a perpetuity which has constant payment of rupees 20, that is equal to the dividend, and this constant payment grows by 2%, and we need to find this cost of capital given that the present value of this perpetuity is 400. So if we apply this formula, we can find the present value, we can find the cost of capital, that is comes out to be 7% in this case. Okay, and we can also verify these calculations in Excel or spreadsheets. Okay, so let me demonstrate this to you. So for example, like, so this is the situation which is given, like the dividend which is given, that is 20 rupees dividend is given, and it is growing by 2%, and cost of capital is, or the discount rate is 7%. Okay, so what we do, like we calculate the dividends for each year. So let's suppose we do the calculation for 100 years, let's suppose. Okay, so in the first year it will be 20 rupees, in second year it grows by 2%, again it grows by 2%, and if we see, like at the end of 50 year the dividend is 52 rupees 78 paisa. Okay, now what we do, like we compute the present value according to this discount rate. So that is simply like the value of dividend divided by the, like the discounted by the interest rate. and the number of periods. So it will be the dividend divided by 1 plus r times the number of, like, to the power number of periods. So you can see the formula here, like the, and the present values are computed in this way. And what we do then, we sum these present values, and that sum is done here. And we see that if we, how many years I have taken, let me show you. Like I have taken 150 years in this calculation. So if I take 150 years, then my share price comes out to be 399 rupees and 695, 399.695 rupees in this case. Why it is not exactly equal to 400? Because for that you have to take more number of periods, like infinite amount of periods we have to take. Like that's why we get some less amount income as compared to the actual value in this calculation. So you can, like, do these calculations for different number of years. So for example, if you assume that company only exists for 50 years, then what will be the share price? If company only exists for 100 years, then what will be the share price? But in that case, it will not be exactly equal to the perpetuity. It will turns down, like it becomes an annuity in this case, because we are constraining the number of years or number of periods in our calculation. Any questions or doubt in these concepts? Okay. Now, like as we have taken the example of loan repayment and stock valuations, we move to the capital budgeting rules. And first we focus on the, like, net present value was covered in the previous lecture, like the basics of that. Now we move to the calculation of internal rate of return, how we calculate, how we get the internal rate of return. So what is internal rate of return? So in crude definition, internal rate of return is the interest rate at which the net present value of a cash flow becomes zero. That is the simplest definition of internal rate of return. So let's take some examples, and like how can we calculate the IRR for these three cases. Like the first case says, like, the initial cost is 1 lakh rupees and it pays 1 lakh 20,000. Second says, in first year you get 10,000 and second year you get 1 lakh 20,000. And third case, like, there are three payments and first is the upfront cost. So here I am showing an example, like if my number of cash flows increases, then what happens, and we will take, like, how we can, if there are multiple number of periods, then how can we calculate this IRR. So taking this simplest example, in the first case, like it is the most simple case, like there is first cost and then you get a one return in one period only, and there is a simple calculation. You can simply put all the values and you find that in the first case the IRR is 20%. In second case, like when you put these values, then you find that you get a quadratic equation in terms of 1 plus IRR. And if you solve this quadratic, then you get two solutions. One is positive and negative, and we know that interest rates are not negative, so we reject the one, and from that we get, like, the IRR equal to 14.66% in the second case. Now when we move to the third case, like there are three, like there are cash flows for three periods, up to three periods. Like then in this case, like we get a cubic equation in terms of 1 plus IRR, and we can solve the cubic. And so in this form you observe that the number of periods, or the number of periods later, you get your your payment or your cash flow goes on, then the complexity of this equation increases, and like the degree of polynomial which you have to solve in order to get your internal rate of return, that increases. Okay, so in the third case, we can solve this cubic equation nowadays. Like a lot of online solvers are available, you can use any one of them and try this, like the put the values of these coefficients of these, like the cube, square, and linear and constant, and you will find this solution. So in this case, we get one solution and two complex numbers. So we reject the complex numbers and finally get the IRR in our case. So we observe, like, to compute the IRR, like in mathematical form, we have to solve some form of polynomial equation. Okay, and we know, like, for a polynomial there may exist multiple solutions, like multiple roots. So in that sense, and there may be some polynomials where there is no root. Okay, so in that sense, we can conclude that there may be a stream of cash flows where you can get multiple internal rate of returns, and there may be the cases where you are unable to find any internal rate of return. Okay, so keep this point in mind, and we will do this IRR calculation in Excel also. So in Excel, it is very simple to calculate IRR. Like, simply you need to put like the simplest formula. Like, if you see this formula, so you simply put like equal IRR, that is internal rate of return, and simply select the stream of cash flows which you are computing. For example, if I give you an example, IRR, so it give you returns the internal rate of return of a series of cash flows. So simply just select the stream of cash flows here, and then you will get your IRR in this case. Similarly, you can do the same thing, like you can select like the a longer stream of cash flows also. So these first project 1, 2, and 3 are the examples which we have taken. And now next, like, there are other examples and you can change these cash flows as for your convenience, and you can see like how this how this your internal rate of return is changing. Now, as I said, like, there may exist multiple IRRs. So when does multiple IRR exist? So when you see a cash flow, and in that cash flow the signs of your cash flow changes multiple times. For example, in this project 7, there is a first cash flow is negative, positive, positive, negative, positive, positive. So there are multiple sign changes. So in this case, like, you can have multiple solutions to your polynomial, and you can find multiple roots, and through that you can find different IRRs. So how can we, like, if there are multiple IRRs, how can we get different value of IRR for a simple cash flow? So for example, if I simply put the equal to IRR formula in this cash flow, I get the internal rate of return roughly equal to like 20.12%. But I know, like, there are multiple IRRs. So in IRR there is an option to, so for example, if I put IRR formula and select the cash flows, and then there is a option to give you an initial guess for your computation. Okay, so depending on this initial guess value, you get your, like, the value of IRR. So you have to try different values of initial guesses, and from that you get different IRR values from this formula. So for example, here if I give my initial guess to be minus 50%, so minus 50% is minus 0.5. Then if I give this initial guess, then my result is minus 46%. But as you know, like, we do not accept the IRR equal to in the negative values, so IRR may be negative, I'm not saying. That is also a solution, so this is also IRR, but like the, like by intuitively or by our general knowledge, we know that this is the true IRR which is there. Similarly, like, if in a stream of cash flow there is no change of signs, for example, if my all cash flows are positive or all my cash flows are negative, in that case, the there will not be any IRR existing for those calculations. Any doubts or any confusion with regard to calculation of internal rate of return?
No, sir, this is good. Can I ask a question about the previous one, question number 2?
Yes, please tell me.
Yes. So we used one formula there, right? I think the Gordon growth formula. Yeah, this one.
Yes.
So what does R mean? That means uh, I have one rate that it is anyway changing by 2% every year, right? The dividend is increasing by 2%. So this R is what?
R is like, as we discussed in the last class, like it is the discount rate which we say, or
So
the cost of capital through which we do discounting for whatever payments or amounts which I will be getting in future.
okay, so this is not the rate that shareholders expect minimum rate, so that 400 rupees is. Gordon
No.
says that, right? So in the textbook, Gordon Growth says that this is the rate they want minimum for it to become financially viable. That yes, it is worth
Yeah.
paying 400 if I get 7% growth every year, right?
Yes. So that's why we and that is equivalent to saying like, if, so that is equivalent to saying like, if this is giving me 7% return, so if I want to do my calculation, I will discount my future cash flows by 7%.
Okay, so if they sell that stock, they must get 7% recovery per year. Then it
Yes.
is profitable. Okay,
Yes.
understood. Understood. Thank you. Thank you.
Okay. So now we got the hold of internal rate of return. So next, like, let's take an example of incorporating all four budgeting rules. So, so let's suppose the prevailing discount rate is 5% per year, and these are five projects under consideration. So the question is like, according to different rules, like there are four rules, which project will you choose under like out of these five? So condition is you can only select one, then which one will you choose? Okay. So, so the first is the net present value rule, and so we can simply calculate the NPVs of these five projects, like by discounting the future cash flows into the present value terms, then doing the simple summation addition of all these cash flows, and we get the net present value. And we, the simple rule under net present value is like, we select the project which has the highest net present value. Okay. So we do the calculations and we find that the net present value for the first project is the highest, like 175.29. That is the highest, and so we out, if I have these five projects in option, then I would select the first project according to the NPV. Okay. And in the, for the internal rate of return, I have used the Microsoft Excel's IRR formula, and we compute the IRR for all the projects, and we find that IRR for the first project is the highest, and according to the IRR budgeting rule, again we select the first project only. So here we observe, like, if my cash flow is in the form like I pay upfront cost and then I get some positive cash flows. If this is the case, then in all my options, then my net present value and my NPV would result in the same, like same selection or same decision. But if the case is, if the another case is like, if I have like changes in the science, like for example I pay a cost now, then I pay a cost after 5 years, then after 10 years, and in between I get my cash flows, then in that case your answer may change in these two budgeting rules. Third capital budgeting rule is the profitability index. That is simply the ratio of my, like the initial cost and the NPV. So in this case also my first project turns out to be the best one. So that generates a, so profitability index is only applied in the cases where in the first period there is a cost and in the later period you get a positive cash flow. So we compute the net present value of my future positive cash flows and divide it by my upfront cost, and through that I compute this profitability index and I get my, like in this case, like the profitability index according to this criteria, the first project is chosen. And according to the payback period, so if we take a look at, like the payback is like the at what amount, after how many periods you get your initial money back, in simplest form. Okay, so I think in your assignments, like there is a question where we use a modified payback rule, where we use the, where we assume like my payments are equally distributed throughout the period or throughout the year. But here, like we take the simple example, like here, like in the only in the second project I get my payment back in 4 years, and all other periods I get my payments in 5 years. So according to payback rule, I should choose the project 2. And we can do all these calculations in Microsoft Excel also, and let me show those calculations also. Like for example, these are the 5 projects. So due to the paucity of space, I have only given you these 5 projects, but here in Excel I have included one more project. Like this final project is project 6, is the upfront cost is 5,000, and in the subsequent 15 years you get 500 rupees in form of return. So this is a kind of annuity of 15 years. Okay, so if we do the calculations for like the NPV, PI, and so for example in this case, like if I do the net present value calculation, you can see the formulas. Like for NPV, I will simply added all the present values of my project 1 to project 6, and for IRR I have simply used the IRR formula for the cash flows. And here you can see, like according to NPV, the project 6 is most profitable, it has the highest NPV, and but IRR is highest in the first case. Here you can see like the results changes for NPV and IRR. And for profitability index also, like here my NPV is higher for project 6, but my profitability index is higher for my first project because my upfront cost is lower. That is a, that is the denominator in my profitability index calculations. So I highly encourage you to take a look at all these calculations, and I encourage you to modify the values which I have used. You choose your own values and do these calculations. You change the this cost of capital or the discount rate, see how the valuation changes, how your results changes. Okay. And I forgot to point out, like, when we compute the IRR, then we compare this IRR with the prevailing discount rate, and if this IRR is higher than this discount rate, then those are worth taking, otherwise they are not. So for example, like, so this is simply saying, like, when this is more than this discount rate, then they give you a positive return. When they are less than this, then they give you negative return, or the negative net present value will be there in those cases. Okay. Any doubts, any concerns, if you have, please do raise, and please have a look at these calculations, and if you have any doubt, please post them in the our discussion forum as well. Okay. So in terms of solving for your assignments, you can use these, like, these spreadsheets for your calculations. But in exams, like, there will not be access to these spreadsheets, so we try to give you the questions which can be solved using simple calculators only. Okay. Now we move to the final part of our week, third week's concepts. Like, first is the time varying rates of return. So for that, like, so in the previous examples, we have taken the examples where the interest rate is fixed throughout the periods. But for example, like, we take an example of valuation of a firm. So suppose you have a firm which, like the in the previous year, your firm had cash earnings of $400 or 400 rupees. Like, these are 400 units. The unit may be anything like 400 crores, 400, like, whatever you want to take. And your team does the forecast, and you forecast that in the first 5 years there will be a quick growth phase, in which, like, your company is very new, and in this phase, like, it is expected to grow at a 40% per annum. Then in the next 5 years, like after year 5 to year 10, your firm grows at a moderate rate, that is 20%, and in 10 years your firm is established, and after 10 years your firm grows at a stable growth rate of 2% every year. And your cost of capital also changes, because if your firm is new, then you face a higher cost of capital. Then if your firm is stable, then you face a lower cost of capital. So in the first 5 years you face a cost of capital of 15%. In next 5 years you face 10% cost of capital, and in the periods after 10 years you face a cost of capital of 8%. So given these conditions, like, what is the worth of your firm in this case? So these type of calculations are very difficult to do by hand. Like, in today's time we have, like, a lot of coding infrastructure is there. You can use Python, etc., etc., if you have understanding of that, or you can do these calculations using Microsoft Excel also. So, but, like, doing this calculation using calculator is very cumbersome. So we can do these calculations in Microsoft Excel, and I think I have done these here. Yeah, yes. Okay. So in the first year earning is 400 rupees. So, like, these are the growth rates, and these are the cost of capital which you face. Like, in first 5 years, I think I should write them in 6 to 10 years. And these are my cost of capital. So I can use these values. So this is the growth rate according to which my earning will change, or my profits will change. So I can get a time series of my earnings. So in my first year I get 400, that grows by 40%. So for 5 years I grow by 40%, then I grow by 20%, then by 2% thereafter. So for example, after 20 years my earnings will be 6,525 according to this growth pattern. And I have different cost of capital which will be used for discounting to compute my present value. So I compute the discount factor, like I simply, like the when there are different, so I will simply keep on multiplying, like keep on discounting this discount factor. So in the first year it is simply 1 divided by 1 plus 15%. In second year it will be 1 divided by 1 plus 15% times 1 plus 15%, and so on and so forth. So for example, in the sixth year it will be 1 divided by 1 plus 15% 5 times plus 1 plus 10%. That will be the case. So I have used that formula. So I have simply, like the multiplied 1 divided by 1 plus r to my previous discount factor. That will be my discount factor for that period, and I will simply multiply my earning with that discount factor, and I will get my present value of my earning. And if I simply sum my present value for, like for example, I have taken 300 periods. So okay, so if I simply sum my present value, I will get the present valuation of my company. So if I, so these are my different assumptions, like if my company lasts only for 5 years, if for 10 years, if for 100 years. So these are like very long period, and which is the general case which we use for the valuations. So if I see the value, so it is roughly something more than $39,000. That is my present valuation of the company given the current cash flows. So to be exact, like if I consider so a, as I keep on growing the number of years, my value will keep on converging to a certain value, and that value is 39,238 rupees. Now, so I have given you a simplest case. Like in reality, they, like these forecasters give you different rates for different years. So first year it will be different, second year, third year. Each year there is different growth prospect. There is different cost of capital. This cost of capital is determined by the prevailing conditions in the economy, and growth prospects are like what are the market dynamics that are under play, and what are the changes you may take, etc., etc. So if I have some accurate, some, like the some forecast for my upcoming years, so I can use them for the valuations. So like nowadays, you in the news, we, like very often we hear like the particular company or this startup is valued at this much, like 15 billion dollars, etc., etc. So how do they come up with those numbers? Like this is type of calculations they do for that. Yeah, this is the simplest case, but you get the concept, like what type of calculations is behind those numbers. Okay, great. So this is the example of like when interest rates are varying over time. And now we take example of annualized rate of return. So for example, like you have a product and you know the lump sum return which you have got, but the more reliable or more appropriate rate of return which you should be focused on is the annualized rate of return. Why? Because that give you, like in a year, how much, like the return you have got. So for example, like you bought a Rolex watch some 7 years ago for this 1,25,000 rupees, for example. This can be any other. So, and this Rolex watch, like if you sell it today, you get 2 lakh rupees. So in 7 years, like you know, like how many, like you got 75,000 rupees in return, so you can compute the your total return in 7 years. That will be 75,000 divided by 1,25,000. That is roughly equal to 60% return you got in 7 years. But you need to convert it to per year term, because the interest rates which you observe in the economy, those are like normally given in the annualized terms only. So for comparison purpose, you convert it to the annualized form. So the annualized return which you got, you can compute it simply by like assuming your annualized return equal to R. So 1 plus R to the power 7 would be equal to total holding rate of return, that like 1 plus 60%. So from that calculation, you find that your annualized rate of return on this transaction is 6.94%, like this investment. Okay, great. So at the end, like I wanted to touch upon like a brief discussion which we had in the last live session, like the no arbitrage condition. So what do we mean by that? So arbitrage in layman terms means like you make free profit. So for example, like there is one asset. So for example, you see, like take example of simple good, in simple goods terms. So you see apples in one part of city equal to, that is selling at 100 rupees, and in some place it is selling at 105 rupees. So assuming that there is no transaction cost or no transportation cost, in that case, like what you can do, like you can simply purchase in the first market and sell in the second market, and you can simply earn a 5 rupees free profit on your transactions. And if you have enough money, you can, like, if this market persists forever, you can make infinite amount of profit. So this is the concept of arbitrage. So similarly, in the form of assets, like if there is one share which is like trading at different exchanges. So for example, Indian share is traded on the Bombay Stock Exchange, and those same are traded on the maybe New York Stock Exchange in the US. So you compare, if there is significant change of prices there, then there is a possibility of arbitrage. Okay, and if markets are perfect, which is the assumption of the asset market. So under perfect market condition, one can make profit by purchasing the asset in the first place, like in the first, if like the price is place where the price is lower, and sell it in the other place where the price is higher. Okay, so the no arbitrage condition states that like there is no such like the opportunity exists under the perfect market conditions. There should not be. So if for instance, like for a millisecond, if such opportunity exists, then like all the investors will go to take on this opportunity, and like this will be exploited by in the millisecond. So this, all the investors will take on this opportunity, and this opportunity will vanish in milliseconds. So this is the concept behind the arbitrage pricing theory. And so in real life also, like you can simply understand this concept by simple demand and supply case. So if we see like the arbitrage opportunity, then there will be high demand for that, and from that concept, like the price will rise in that exchange, and that will, this arbitrage opportunity will cease to exist in like the momentarily. Okay, so I just wanted to touch upon this arbitrage condition, and this is it from my side for this week's discussion. If you have any other questions, any other doubts related to week 1, 2, or 3, please do let me know. Okay, then I would leave you with questions for you to solve, and which we can discuss in the upcoming section, like the next week section, if session, if you want. So the question states like, what is the maximum price you would pay for a standard 8% level coupon bond with semi-annual payments, like it pays two times in a year, and it has a face value of $1,000, and it has a 10 years of maturity, and the prevalent discount rate or your cost of capital is 10% per annum. If this is the condition given, then what is the maximum price which you would like to pay? So here what you have to do, like after 10 years you will get the face value, that is 1000. In between 10 years, like there will be 2 times 10 20 coupon payments that you have to calculate. What would be those? You have to discount those coupon payments to compute the present value, and that present value will be equal to your, like, the willingness to pay for this bond at present. So do this calculation on your own. You can share your results on the discussion forum, or we can have a discussion if you want. If you want in the next, if you want then in the next week.
Sir, uh,
Yeah.
sir, for the IRR, mm, that those questions and the like, I understood the concept, but while solving the questions, I'm finding it a bit difficult. So, is there any other resources, maybe some more questions which I can practice? Because uh, I feel that if these IRR questions like that, like the more complex ones, if it comes in the quiz, then I might face problems. So,
So in IRR case, in the exams, like you may expect the linear or the quadratic cases, like the if case flows comes up to two periods. So we try to refrain for going for beyond that, because that will be very complicated calculations. It will be very complicated to solve higher order polynomials in the exams. Okay.
yes, sir.
Yeah, you for practice, like you can do some problems from the Welch's book, which is given as a reference in the slides. And if time permits, then I will also frame some questions for you to practice before the quiz one, and I will share, like, after week 4, or then I will share those questions with you. You can do practice over there.
Okay, sir. Also, sir, for the quiz, so if we do the graded assignment and the live session questions, so will that be okay for all topics? We need to go for the that book reference book we have.
Like like you should go through the slides, and you should, like, the concepts which are discussed, like you should have a good understanding of that. Like, we solve only the numerical problems in the live sessions or the assignments, but in the quizzes there may be some, like, the conceptual questions also. So going through the slides, if you have any doubts, refer to the like the book, then that would be, I think, enough for the quizzes and other exams also.
Okay, sir. Thank you, sir.
Right. Thank you, sir. Good session. Thank
Okay.
you. Sir,
Thank you.
the question that you gave us, so I have to calculate the face value as well as the coupon present value, right?
Yes.
So 400 plus 500, yeah, around 900 rupees. Okay, I'll do it, sir. I know how to do this.
Yeah.
I mean, I don't know the formula, but I know how to do it normally. Okay. Thank you.
Okay. Thank you. Thank you everyone for attending. See you next week.
Thank you.